Happy Wednesday. This year is going by so quickly. Definitely back to school time. My kids have a couple more weeks, but most of the schools are in session here. I guess I will say I did a walk and talk with a client yesterday out at the beach, hence the pink in my cheeks and my neck. For anybody that wants to do that, we talked about business, we talked about family, we had no shortage of things to talk about for over an hour, just going for a walk on the beach. It was fantastic. Get a little vitamin D, get a little business talk, and get some exercise. So, if anybody wants to sign up for that, there is a specific link in our newsletter, which, by the way, you should have gotten our second newsletter this week. So, over the next several months, we're going to be doing several new topics. This month, we're going to be talking about tax smart investing. In September, we're going to talk about Social Security, when to take it, how to take it, all of that stuff. In October, we will talk about estate planning basics, trusts, wills, that kind of stuff. In November, year-end moves, things that you can do ahead of the year end to help with taxes, set you up for next year. And then in December, we'll talk about family legacy with Christmas coming up and all of that. It's a great time to talk about giving gifts to the family. So again, here's a little bit more detail on what we're going to talk about today. When you invest, it's not just what you're earning that matters, it's what you keep. And so there's many ways to determine that. So for example, on my walk yesterday, we talked about the difference between short-term and long-term capital gains. So how long you hold something. If you hold it less than a year and it's in a taxable account, you have to pay ordinary income tax on the gain. So it's as if you earned that money at a job. Whereas if you hold it for over a year, you only pay capital gains tax, which is around 15%, 15 or 20, depending on your income. So we'll get into a little bit more detail there. Again, next month, we'll talk about Social Security and timing and strategy. Following is estate planning. Again, talking about trusts and what documents and all of those things that you need to be prepared. The fourth month, the financial to-do list. And then fifth month is family legacy. So we'll hopefully be adding some things within the newsletter and some tools that we're building between now and December for that. Okay. So again, what you keep after taxes is what matters. So you could earn 100% returns, but if you pay taxes on 80% of that, it's not worth the risk or the timing or any of that. So one of the ways to kind of manage that tax situation is asset allocation. So making sure you're invested in different asset classes. So this is a very common theme that we've talked about with investing in non-correlated assets such as precious metals, gold and silver, which, by the way, gold and silver has seemed to come out of its doldrum the last week or two. I think silver's been up 15% in the last 2 weeks. So we're starting to see those things come back. So there's asset allocation. Now, what we're talking about here is asset location. What type of account are they in? So you have your tax deferred, taxable, and tax-free accounts. So tax-free would be your Roth. Permanent life insurance is considered a tax-free account because you can access that money tax-free. Taxable account would be your traditional individual joint trust accounts. And then your tax deferred is your traditional IRA or 401k. And how you invest in each of those could potentially be different. You may invest the same, but what assets you harvest when money's needed may be different. So there's a few different factors in there when you're looking at your investments. And then one of the things you want to look at is if you're in retirement and you're drawing income, which account are you drawing it from? And in which years based on your tax situation. So there's a whole bunch of different levels of complexity there. So I'm just going to skip down to the table here. Really what you want to understand is with your traditional IRA and your 401k, it's a tax deferred growth account. And what that means is you pay taxes when you take the money out and it goes in tax free. So if you're contributing to a 401k during your working years, that money gets subtracted from your income. And so you don't actually get taxed on it. So it's a good way to reduce your taxes in a given year. However, that money gets taxed as ordinary income when it comes out. So every dollar that you earned and every dollar that you contributed is taxed as ordinary income in the future. So if you want to think of it like a farmer, as a farmer, would you rather get taxed on the seeds that you're putting in the ground or on the crop that you're harvesting? So a Roth is the complete opposite. It's you get taxed on the seeds and then you can take out as much as you want tax-free in the future. Both are very valuable. Both you have no idea 10, 15, 20 years from now what the tax situation is going to be in the country. Right now, we're at historically low income tax levels, so could potentially go higher. We could also go lower. So you want to have money in both of those buckets to be able to draw income in any given year from the one that behooves you in that year. The other piece of this equation is doing what are called Roth conversions. So if you have low income tax years, say you're living off of your investment account for a while, and so the only income that you're showing is capital gains and dividends, you may want to start doing Roth conversions from your traditional IRA or 401k to your Roth IRA, taking assets, paying taxes on them now before they've grown more, and putting them into that tax-free bucket. So any growth and any contributions going forward are tax-free. And again, that's a balancing act on keeping your taxable income below certain levels and not creating problems in the future. So again, we just mentioned it, but that third bucket is your taxable account. Again, individual, joint, transfer on death, trust accounts, those are all examples of taxable accounts. And those ones you want to be able to manage the assets in a way where, for example, treasuries, the interest you earn on treasuries is taxable for federal taxes, but not taxable for state. So that allows you to take advantage of that in that taxable account. Dividends on many different stocks and funds are tax advantaged dividends. So you're paying a tax rate of 15% instead of ordinary income on those dividends. And then, of course, the ability to manage the taxes on gains versus losses. And so we'll talk a little bit more about that in November when we go into the taxes and being prepared for the end of the year. But if you've taken gains throughout the year, or you have something that's gone up and you'd like to sell some of it while it's high, then you can offset those gains with losses and hopefully at least minimize the amount of taxes you would owe in a given year. And so all three of those accounts are important. You want to be able to utilize all of them. So again, there's a useful metaphor, which is the three types of accounts are now, later, and never. So some are taxable now, your taxable accounts. Some are taxable later. That's your IRA, your 401k. When you take the money out, it's taxable. And an important piece for that is the fact that with those retirement accounts currently at age 73, you have to start drawing. The IRS says, okay, we gave you this huge benefit, not taxing it for years. Now you're going to pay taxes. We're going to force you to take a percentage of it out each year. So the later jar starts being taxed whether you want to use it or not at 73. And then the never jar, the Roth, is never taxed again. So that's one of those things you want to protect. If you don't need to draw from your Roth, you may want to let that just continue to grow and help subsidize your income later when it won't affect your tax situation. So bottom line, what we're really trying to do is make sure the investments and the income that we draw from each of these accounts is structured in a way to maximize your tax situation. And for each of you, that's going to be a little bit different. And for each of you, it's going to change year to year. It may even change month to month based on how certain assets are performing. So hope this answered a few questions there. And what questions do you have for me?
In the meantime,
Okay.
I'll hit the fun disclosure slides.
While we're doing that, does anybody have any feedback, any questions, any topics they'd like us to cover in the newsletter going forward? And those will be going out twice a month.
So family gifting in the newsletter, that would be helpful.
Okay, great. I appreciate your time. We'll talk to you guys soon.
Thank you,
Thanks,
Matt.
Matt.
Yep.
Thank you, Tracy.
Thanks, Tracy.
Bye, guys.